Hey everyone, welcome to today's video. One of the number one questions that we get is how do foundation capital private real estate trust investors make money? So in today's video, we're going to talk about building valuations, how those are determined, how foundation capital strategy works, and what it looks like on an example building and how that all goes through. So if you're on this video here today, you probably know as Foundation Capital Private Real Estate Trust, we buy multifamily buildings that are anywhere between 10 to 50 units in size that have typically been neglected by the previous landlord and are from the 1970s or earlier. And because of the neglect, they haven't been upgraded and they're usually commanding much lower rents, typically anywhere between $600 and $800 a month. Our strategy is to come in, find the tenants an alternative place to live, or transition them to other housing, or mutually agree to vacate the unit, and then we go in and spend $40,000 to $50,000 renovating the unit, sometimes more, and then we put in a brand new quartz countertop, looks like a brand new condo unit, and we're able to command anywhere between $1,600 to $2,000 a month in rent. By doing this, we're able to increase the cash flow for our investors, but also increase the value of the buildings, allowing us to pull the money we've spent buying the building back out and generating a higher return for our investors, both increasing the monthly cash flow that they're receiving and the value of the units of the shares that they're invested in. So let's jump into an example and go through how we make money for our investors. So if you watch our other videos, you know that apartment buildings are valued based on net operating income. So for you to understand what that includes, operating income includes your gross income minus your vacancy, take your chargebacks and laundry that you might add back in to get to your effective gross income. From your effective gross income, you deduct all your expenses. So these are all your typical expenses that you might be able to see. Again, in here, landscaping, snow removal, custodial is just part of the salaries and repairs per unit that we factor in here to get a total expense of $83,000. So the net operating income on this building with low rents is about $55,854.19 is what this translates to. So again, your rents minus your expenses gives you your net operating income. And in previous videos, we've covered how using net operating income, we determine the value of the building based on cap rates. So depending on the cap rate, a monthly increase in rent of $1,000 a month has an immense impact to the value of the apartment building. So you can turn over one unit on a 4.5 cap, you're able to increase the value $267,000 basically, or $240,000 under a 5 cap, $218,000 under a 5.5 cap. Obviously, this is not considering that you are probably spending on legal and relocation costs. You probably have $15,000 there. Renovations, you can say, let's call it $45,000. And then on the placement and vacancy, on turnover, you're probably looking at about, let's call it 2 to 3 months at what you would have is your $1,000, or let's call it $1,500 for like an extra month there or vacancy. So call that $4,500. Your all-in cost to get this turnover is going to cost you $64.5K. So your net benefit would be, by doing all this work, on at least a building value increase is $202,000. Again, this is going to be the same value for these guys here, because it's not going to do any difference. So the amount of the value net benefit just adjusts accordingly based on how it's going. So in all scenarios, it tells us that getting the turnover, spending the dollars to get the vacancy is totally worth it. So if you guys recall watching another video of ours, if you go back and watch the 12-plex analysis in London, Ontario, we do an example of a building that we were purchasing and the mortgages and sort of the bank versus CMHC standard versus MLI select. So actually I've taken that building and done the analysis of what doing all of this translates in value for investors. So as an investor, buying into the building, in order to buy this building, we had to put about $890,000 or $891,000 in equity into it, let's call it. On a current share price of $12.65, which is our current unit price, that means there's about 70,415 units outstanding related to this property, as if we were to allocate it, we'll call it that. All right. And then we spend $188,000 to turn over these 3 units. Again, this is what we determine as the carrying and tenanting opportunity cost, the renovation cost, and the turnover costs related to this. It would be $188,000. So now when we take, again, the net operating income, the new net operating income, and we divide it by the cap rate, the value that we determined was $3,366,630. And we determined that the mortgage you'd be able to get on this building after you got those turnovers to be $2,197,046, which would mean the new building value minus the new mortgage you're getting would actually give you a total all-in equity value that the fund would own in this property of $1,169,584. Okay, and that's with us still taking a mortgage increase of $437,793. So we're pulling out this new mortgage amount of $437,794. We spent $188,000. So in our pocket, we're going to be putting in, or into the fund is going to net take out $249,793 after it spent the $188,000. So we got, the fund takes out and there's that immediate cash benefit here. We see that turnover value that we've increased here as well versus the $890,000 versus the $1,169,584. But there's also a cash flow impact. So the monthly rents went up about $3,000 a month, 3 units times $1,000. The corresponding expenses on a monthly basis only went up $211.19 for a net benefit of $2,788.81. In order to take this increased mortgage of $437,793, that costs the fund $1,879 on a monthly basis for a net benefit of $909.79 a month of increased total overall cash flow on a monthly basis. This is the net increase by doing this whole exercise. So we take the turnover value of where it is minus the equity that was originally the value before us doing any of the work, plus the cash that we're taking out. This is the net increase in the value for the fund by doing all of this work that we did here. And so when we compare the unit price now, so again, we determined that the unit price for these units was $12.65 and there's $70,415 outstanding. The new unit price ends up being $20.16. Again, this is taking the ending equity value that we have here plus the cash on hand divided by the units outstanding. There's a small nuance here. Obviously, this is assuming we didn't buy any other buildings, we didn't have any other carrying costs, there weren't any other financing costs. So there's some other factors into it, but this is actually how we are driving the unit price up. And then we'll also adjust the unit price to ensure that the monthly increase in cash flow is also making sense. So what we'll do with this additional cash that we've taken out is utilize it towards getting additional renovations and turnovers in buildings that we already own to continue to increase the cash flow. And we'll look to refinance, and as we refinance, again, we'll use it to buy other buildings, do these renovations, and sometimes it's also used to do a one-time special distribution back to our investors, and otherwise it's used to buy back shares from investors who are looking to redeem and get out. And ultimately, this is our strategy of what we do at Foundation Capital, the value add strategy, where we buy these older buildings, we get turnovers, we increase the rents, and this is mathematically how we increase the cash flow for our investors and increase the value of their underlying holdings and their unit price by pushing the values up and taking it out. So if you guys have any questions about how all of this works, Hopefully this video described how we make foundation capital real estate investors, foundation capital private real estate trust investors money. And so just to recap, what we do is we buy older apartment buildings, we turn them over, we increase the rents, and when we increase the rents, the cost of renovations significantly outweighs, or the benefit of doing the renovation significantly outweighs the costs. And that's how we continue to increase the net operating income and cash flow for the fund and increase the value for investors, driving the underlying share price up. If you guys have any questions or concerns, put a comment in the video below and I'll answer it. Hopefully this was a concise and easy way to understand and explain how we push the value of the fund up and the share price for our investors. Thanks.